Okay, so let me just ask you something real quick before we dive in. When's the last time you actually sat down and asked yourself, like genuinely asked yourself, is my money actually safe? Not just is it in my account, but like, is it truly protected? Because, most people never ask that question. And that's kind of the problem, right? Because here's the thing, there's a really uncomfortable reality that almost nobody is talking about. And I don't mean the stuff you hear on the news every other day. I mean the stuff that serious, long-term investors and people who've been around financial markets for decades are quietly whispering about. The kind of conversations that don't make it to mainstream headlines because, well, they're a little too uncomfortable. So let's just talk about it, just real talk about what's actually going on and what you should probably be doing before Monday the 8th of 2026 comes around and you're still sitting there waiting. Let's start with something that might sound a little old-fashioned to some of you. Gold. Yeah, I know. Some of you are already rolling your eyes like, it's 2026, nobody talks about gold anymore. And honestly, that reaction right there is exactly the point. Because while everybody's out here chasing the next big crypto play, or some AI stock that's supposed to make them rich overnight, gold has been quietly, and I mean quietly, doing its thing. No hype, no viral tweets, no influencers pushing it. Just slow, steady, boring performance that has absolutely compounded over decades. Think about this for a second. Back in 1970, gold was sitting at $35 an ounce. $35. Right now, we're looking at numbers that are many, many times that. And here's the wild part. There hasn't even been a massive speculative frenzy around it. The ETF inflows have barely picked up. Go out to any bar, talk to regular people. They're talking about sports betting, about some new investment app, about the latest meme coin. Nobody's talking about gold. And that's kind of fascinating when you think about it, because one of the oldest stores of value has been putting up impressive performance while basically nobody at the retail level is paying attention. That's not a coincidence, by the way. That's actually a signal. Now, here's where it gets really interesting and a little bit uncomfortable. Who is paying attention to gold? Central banks. The very same institutions that have been managing monetary policy, running the printing presses, and yes, contributing to the inflation that has eaten into your purchasing power over the years. Those guys. They're the ones quietly, steadily accumulating physical gold. And you might be asking, should that worry me? Should I be skeptical about being on the same side of a trade as the central bankers? That's actually a really fair question. But think about it this way. Many of these large central banks are sitting on massive, unacknowledged losses on their own bond portfolios. Like if you applied private market standards to some of these balance sheets, you'd have a serious problem. So is the gold accumulation a geopolitical strategy? Maybe. But it might also just be a silent hedge, an insurance policy against the very instability that they themselves helped create. That's the uncomfortable reality. And when institutions that literally print the currency start quietly hedging against their own potential insolvency, that probably means you and I should be paying attention too. But okay, let's back up a second because I don't want this to just be a gold pitch. This is actually a bigger conversation about how we think about protecting wealth and how most people are getting it completely wrong. So here's the thing about how we were taught to handle money. A lot of us grew up with advice that sounded really responsible. Save your money, put it in a bank, keep cash on hand. And look, that advice made sense in a certain era. But over time, the depreciating purchasing power of paper money has made pure cash savings kind of a slow disaster. And yet, here's the crazy part. The cash position of investors right now is at one of the lowest points in history. People trust cash least at the exact moment that uncertainty is highest. That's a really telling behavioral signal. At the same time, you've got younger investors, totally understandable, by the way, going after the fast-moving stuff. AI stocks, crypto, high-velocity assets, because the promise is there, right? The excitement is there. Gold is boring. Gold doesn't go viral. Gold doesn't have a community of passionate holders posting about their gains. So yeah, from a pure engagement standpoint, gold loses every time. But from a long-term purchasing power standpoint, that's a very different story. So let me give you a kind of mental framework that I think is actually more useful than just asking, is gold up or down right now? Instead of measuring everything in dollars, try measuring things in ounces of gold. Like, how many ounces of gold does it take to buy a house right now? How many ounces to buy a barrel of oil? How many ounces to buy a bushel of wheat? Because when you do that, something interesting shows up. A lot of real assets, energy, food commodities like wheat, corn, soybeans, are actually historically cheap relative to gold right now. Even labor costs, when you measure them in gold terms, are relatively low. And that tells you something. It tells you that the narrative isn't necessarily that gold is expensive. It might actually be that a lot of other things have simply lagged. And here's the flip side of that. When you look at markets, when you look at financial assets, there's been a massive celebration of risk. People chasing assets, chasing velocity, chasing leverage. The mania investor mindset is all about getting rich fast. Gold is almost the exact opposite of that. It's not a promise of quick wealth. It's a way to protect purchasing power over time. Boring? Absolutely. Necessary? That's what the data over the past 50 years seems to suggest. Okay, so let's talk about actually building a defensive portfolio, because I know that's what a lot of you are actually here for. What does a reasonable allocation look like? So look, it depends on your situation. If you've got a lot of real estate, if you're already diversified in certain ways, your starting point is going to be different. But as a general rule, and this isn't advice, this is just a perspective worth considering, somewhere around 25% of liquid assets in physical precious metals is a number that gets thrown around by serious long-term investors. Some people go much higher. Like, there are serious investors who have 80% of their wealth in gold. Now that's very courageous, and it comes with a real trade-off. Gold doesn't pay you income, no dividends, no interest. So you need to understand what you're signing up for. Now let's talk about bonds for a second, because this is a piece of the puzzle that people often ignore. Long duration bonds like 30-year treasuries, their prices from the peak in 2020 have been cut nearly in half. Cut in half. Now, you did get your coupon payments, your interest along the way, so the total return isn't as catastrophic as that sounds. But it's a real illustration of duration risk. And right now, with recessionary forces potentially building, because if asset prices drop and consumption slows down, things can get ugly fast. There's actually a short to medium term case for having some exposure to cash and bonds. Not forever, just strategically for the next 6 months to a year. It's not a permanent conviction, it's a positioning move. All right, now I want to talk about something that a lot of people skip over when they think about precious metals and wealth protection, and that's custody. Like, who's actually holding your stuff and where is it? There's a historical story that really hammers this point home. Think about one of the most affluent families in early 20th century Europe. They had an enormous amount of gold stored in a vault in Switzerland. We're talking something like 250 tons. And then when political conditions shifted dramatically, a hostile regime essentially came to them and said, "You want to keep your business empire, you hand over the gold." Don't hand it over and we take everything and send you to the camps. Now, I know that sounds extreme, and hopefully none of us ever face anything remotely like that. But the lesson here is really about custody and control. They had the gold. They couldn't really protect it. The location, the legal framework around it, all of that mattered enormously when the pressure came. And here's the thing. This applies to your assets today too. Owning gold through a bank, or even having it stored in a certain jurisdiction, is not the same as truly controlling it. There's a difference between ownership on paper and actual physical access to your wealth. Financial institutions and governments have historically treated those two things as interchangeable right up until the moment they didn't. And then people found out the hard way. So where do you actually store it? This is where it gets practical. There's a growing infrastructure of storage solutions outside the traditional banking system, places in Singapore, Switzerland, Dubai, Australia, that allow you to physically hold precious metals in a vault that you can actually access outside the banking system. Now, even Switzerland isn't a perfect answer because the political winds shift everywhere. But the principle is jurisdictional diversification. Don't put all your eggs in one country's regulatory basket. If you've got land, obviously physical storage on your own property is an option, though that comes with its own set of risks and responsibilities. The broader point is that most investors think about diversifying their assets, stocks, bonds, real estate, but almost nobody thinks about diversifying jurisdictional exposure. And that gap becomes painfully visible only when restrictions arrive faster than anyone expected. What about gold mining stocks, by the way? That's a different animal. If you buy mining stocks at the right time, you can make a lot of money, potentially much more than just holding physical metal, because you get leverage to the gold price. Right now, there's an argument that mining stocks are actually pretty cheap relative to everything else. But physical gold under your control is a fundamentally different kind of asset than a share in a company that digs gold out of the ground. Both have their place. They just serve different purposes. And silver and platinum. Both of those look relatively cheap compared to gold right now, by historical standards. So if you're building out a precious metals position, those are worth considering as part of the mix. Now, let me bring it back to the big picture for a second, because I think it's easy to get lost in the tactics and miss the bigger thing going on here. We are living through a period where the purchasing power of paper money has been in slow, persistent decline for decades. And the advice that worked for your grandparents, save your money, put it on deposit, keep it in cash, that advice has been quietly devastating in real terms. Because every year inflation has taken a little bit more of what that cash can buy. And now we're in an environment where long-term bonds have taken big hits, stock market volatility is real, and the institutions that are supposed to be stable anchors of the financial system are dealing with their own unacknowledged problems. Here's something that doesn't get enough attention. In the 19th century, before central banks and before the explosion of economists and financial strategists running the narrative, the price level in 1900 was actually lower than it was in 1800, lower, because productive innovation drove costs down. The big industrial builders of that era, they made enormous fortunes, but they also made everyday goods and services cheaper for ordinary people. That's a very different dynamic from what we've had in the modern era of monetary management. The uncomfortable question isn't whether governments should exist or whether policy is good or bad. The real question for an investor is current policy protecting productive capacity and opportunity, or is it mostly protecting asset values for people who already have them? Because the answer to that question has a huge bearing on where the next decade of wealth creation and destruction actually happens. So let's bring this all the way back to where we started. Monday the 8th is not that far away. And the point isn't that something dramatic is going to happen on that specific date. The point is that people keep waiting. They keep saying, I'll sort this out later. I'll think about it next week. I'll start being more intentional about my money when things settle down. But things don't settle down. They just change. The investors who come out ahead over the long run are not always the smartest ones. They're often just the ones who are consistent and disciplined, who bought a little bit every single day, a little gold, a little stock, whatever fit their situation, and who didn't just leave everything sitting in a depreciating cash account waiting for the perfect moment. The mania investors who are always chasing the next hot thing, they show up at the party late, they leverage up, and they get hurt when the music stops. The quiet accumulator who understands real value and relative pricing. They don't make the most exciting content. They don't have the most viral posts, but they're building something durable. And here's the final thought I want to leave you with. Everything is in some kind of danger zone right now. Cash, bonds, stocks, real estate, all of it carries some form of risk. But the biggest risk of all might just be doing nothing, waiting, assuming that what worked before will keep working, assuming that the institutions you trust with your wealth are as solid as they say they are. Start thinking about custody. Start thinking about jurisdictional exposure. Start thinking about what your money can actually buy, not in dollar terms, but in real-world terms, and start doing something about it. Not on Monday, now. Because the people who protect their wealth are almost always the ones who started paying attention before everyone else did.